Hi, I'm Pattu from FreeFinCal, and let's consider a situation in which many investors investing in the same fund via SIP have a huge difference in returns. And why is that? And this is often baffling because this typically happens because when you are running an SIP in a fund and you ask your friend to start an SIP and he or she starts an SIP a couple of months later, and then after a year or so, when you compare returns, the returns will be very different. Why is this the case? So let's understand this via an example. So this is a set of SIPs in DSP small cap fund or DSP micro cap fund. This is a bit of an extreme example, but even for a large cap fund, this is possible, and I've shown an example for a large cap fund in the description box. You can have a look at that link. So what we're going to look at is we're going to consider 15 different SIPs or 15 people starting SIPs in different months. So the first investor starts the SIP on the 2nd of January 2013, the second of investor in February 2013, March 2013, and so on and so on and so on up to March 2014. So we're going to have a 15-month window. So in each month, an investor is going to start an SIP, and if they compare the returns in February 2019, that is on the 21st of February 2019, the first investor would have gotten a return of 14.4%, second investor a bit less, third investor a bit less, a bit less, a bit less, and a bit less, and so on. And some of them, and investors 11, 12, 13, 14, and 15, they've got less than 10%. In fact, the last couple of investors have got something like an FD return. So the first two investors have got twice the return of the last two investors, and it's all in the same fund, and they're all started an SIP in the start of the month, and there's a huge difference. The SIP amounts are the same, but immediately when you look at it, you will say, the SIP amounts are the same, but the total investment value is different because the investment periods are different, so the current values are different, therefore the returns are different. Well, not quite. So let's have a look at that too. So again, I'll give you an example of investor 1. This is an SIP started on January 2nd, 2013 for 811 rupees, and another SIP started on January 2nd, 2013 for 1000 rupees. So the total investment is different in both cases, but the returns are the same. Of course, the units will be different, the value will be different, and so on, but the return is the same. Similarly, for investor 8, you can see that this is an SIP started on 2nd August 2013. This SIP amount is 896, and the SIP amount here is 1000 rupees. The investment amounts are different, values are different, units are different, but the returns are the same. So this phenomena that you see here is not because of the amount which is invested. It is because of when the investment was started. So again, that's a look at the returns for different SIPs this is the SIP start date versus the final return. You can see this big difference, like 14% plus to 6% windows. It's a huge window, right? Obviously, the reason you know is because, see, let's have a look at that. So this is the NAV of DSP microcap or small cap regular fund. Of course, the SIPs that you saw wasn't the direct plan, but just for the history I've shown you. So all the SIPs were started in this yellow window here, right here, and we are calculating the final return here. Of course, you know that why the return is falling is because each of them, for example, this guy started investing here and had a window of that much, whereas the last guy started investing here and had a window of that much. And of course, the final returns have been influenced because of this huge fall, right? And that's the reason why I said in another video that do not assume that SIPs will reduce risk. They will not reduce risk. If there's a huge fall, it will fall. But the point I want to make in this video is that when you start, this data tells you when you start the SIP matters. So for this data set, we are looking at the final return on the same day. We are calculating the final return on the same day. That's February 21st, 2019. But the start dates are different. And therefore, clearly, when you start the SIP or when you start investing in an equity fund or a stock or any market-linked product actually matters. Another point is that when, of course, this is in hindsight, when those 15 investors started their SIPs, they would have only this much data. They would have had this data to look at. That's their that's the past performance of the NAV, and then they would have started the SIP. Fine. Now let's take a look at another situation. We will now change both the start date and the end date by 1 month. So again, we'll have the first SIP started on January 2nd, 2013, ended on January 2nd, 2018. That's a 5-year window. We will move this 5-year window by 1 month. So from February 2013 to February 2018, one more month, March 2013 to March 2018, and so on and so on and so on, until March 2014 to February 2019. That's the last window. Maybe there's just 1 month short here in the 15th period, but that doesn't matter too much. So again, you see here the difference in SIP, 5-year SIP is huge. 37% for the first 5-year window and 6% for the last window. That's even higher than what you saw in the previous case. And in this case, what is happening is both the start dates are changing and the end dates when we calculate the returns are also changing. So that means start dates matter and end dates matter for equity investing or any market linked investing. When you start matters and when you calculate the returns or when you redeem matters, because the sequence of returns or the market movements, so for example, from this point to that point is different from this point to that point. That's called sequence of returns risk. So everything matters. So you cannot compare. So the guy who started here would have got only 6% return, but the guy who started right at the beginning of that period would have got 37% return. So the person who started here and finished here got 37% return, and the person who started here and finished here got 6% return. So essentially, it's like when you start matters, when you finish matters. And if you look at the 5-year rolling return, SIP rolling return of DSP BlackRock, you'll see something amusing. So there are like each data point here is a 5-year SIP, and you can see that the SIP. So you start from something like 5% return, it goes all the way to 30-35% return, and then it drops down. So it's like a cup-like scenario. So you cannot tell. So people ask, okay, I'm going to start an SIP in DSP small cap. Tell me how much return can I expect? Who can say? Unless I'm a sales guy wanting to get commissions, if I had any conscience, I will say I don't know. The truthful answer is I don't know how much return to expect from a 5-year SIP in DSP microcap fund or any mutual fund for that matter. So it's a bit like this. It's like blind men touching different parts of the mutual fund, and some getting high returns, some getting low returns. So the message I want to convey in this is, when you start investing matters, when you finish investing matters, and each person, that is you as an investor, is experiencing a set of market movements within the time period from the date you started investing to the time period you are looking at. The star rating agencies are looking at the fund at a different time frame. You may have started your SIP last 1 year. The star ratings would be seeing the mutual fund for a combination of last 3 years and 5 years. Or you may have started investing for the last 10 years, but the star rating will only see it for the last 3 years and 5 years. So every window that you choose, every slice that you choose will give you a different result. It is basically like blind men touching an elephant. And this is important to understand. Please do not go by past performance. Please do not expect anything from mutual funds. Please have a clear goal, have a clear asset allocation, and reduce risk in your portfolio systematically. Do not have a target return in mind. It is stupid to have a target return. Have a target corpus in your mind. Rebalance your portfolio and make sure you achieve your corpus. Nobody is going to give you a reward for getting 35% return. What finally matters is whether you have money for your goals. And so focus on the money needed for your goals and not on target returns, because you cannot expect anything from mutual funds or stocks. So I will finish this presentation with this poem. So this is the poem that led to that picture, John Godfrey Sachs's poem. You can just have a paused video and read it, or it's available in Wikipedia. So the last couple of lines are wonderful. Though each was partly in the right, all were in the wrong. And that's essentially how the star rating agencies, mutual fund investors, when they start expecting something and when they look at the fund performance, they will all have different perceptions and different expectations, and finally their impressions of the performance will be different. So do not go by star ratings. You look at your financial goal and you look at fund performance from that perspective. Then you can be a much peaceful and contented investor. So I had written a post called Blind Men and the Mutual Fund. It's linked in the description box. Do have a look at that. That's with respect to a large cap fund. So I'll catch you in another video. Thank you for watching. Bye bye.